Hi, and welcome to this week's market presentation. Latest news. In the latest news, tensions between the US and Europe were rising over the last couple of weeks regarding the sovereignty of Greenland. But recently, over the last few days, President Trump reversed the threatened tariffs against 8 European countries that were set to take effect in February. Overall, markets remain more on edge given the various geopolitical risks that we see around the world, but certainly the de-escalation of tensions between Europe and the US being a welcome sign for markets. Over in North America, extremely cold temperatures have been sweeping across the US over the weekend, resulting in a disruption to natural gas domestic production and distribution. Overall, we've seen reports of over 175 million people impacted, with Texas in particular facing freezing temperatures. The disruption in US gas production saw decreases in the order of 15% of domestic output, which then resulted in a reduction of feed gas from LNG terminals and LNG exports out of the US. Domestic gas prices in the US surged 70% to 3-year highs, with the front month increasing above the $6 per MMBTU price level. The reduction in US LNG gas exports and the rising price competition for US gas between the domestic and foreign markets have led to an increase in the level of gas prices in Europe, with the TTF price surging above 40 euros per megawatt hour on tightening supply fears. Additionally, crude oil production was also affected, with shut-ins of around 250,000 barrels per day in Bakken and Texas oil fields. Weather. Moving on to the weather forecast across Europe, we note relatively modest temperatures forecasted over the next 7 to 10 days, in line with the seasonal averages for this time of year. One exception continues to be Northern Europe, and in particular the Nordics, which will continue to stay well below average temperatures over the coming 10 days. Precipitation is also expected to pick up across Europe, with higher levels of precipitation forecasted across most of Western Europe. Lastly, in terms of average wind speeds, we are seeing an increase in wind speeds, particularly over northern Germany and Poland through the middle and end of this upcoming week. Microeconomics. On the microeconomic front, inflation figures were released for the month of December for both Japan and the UK. In Japan, we saw a deceleration of inflation over the course of the last month of 2025, with year-over-year inflation now at 2.1%, while core inflation decreased to 2.4%. Over in the UK, inflation remained stickily above the target set by the central bank, with year-over-year inflation at 3.4%. Crude oil and LPG. Looking at crude oil markets, crude oil prices saw an uptick in prices week over week, with WTI prices up almost 3% for the front month week over week. Brent, a slightly lower increase at 2.7%. Overall, markets remain oversupplied over the coming months and expected to last through the entirety of 2026. Nonetheless, the geopolitical concerns regarding the situation in Iran, where the US continues to increase its military presence in the Middle East, with concerns of US military intervention in the country impacting the country's 1.4 million barrels per day of oil exports. Additionally, the extreme weather in the US, which has already resulted in supply disruptions and production cuts for crude oil, adding to the tighter supply and demand conditions expected, particularly for the front month. Natural gas. Looking next at the natural gas price evolution in Europe, we see that surge in spot prices up 30% week over week. Pricing for the remainder of 2026 similarly saw additional upside over the past week, with the front quarter up almost 3% on the week. The Frontier calendar 2027 products saw a similar 3% increase week over week as supply and demand expectations have continued to tighten over the past week, driven by the short-term concerns over price competition and additional import of LNG, given the situation in the US, but also given the lower storage levels across Europe. Looking next at European gas storage levels, we note storage levels have continued to decrease over the past week, now around 46% full. Compare that to last year's levels, we note a nearly 12% lower storage level this year versus the last year, which has been raising concerns over what withdrawals throughout the remainder of the winter will be and what that will mean for injection demand through the coming months ahead of the following winter season. Overall, withdrawals from storage eased off slightly at the beginning of last week as temperatures moderated, but once again began increasing over the last 7 days. So far in 2026, the overall rate of withdrawals has been larger than the previous year, continuing to keep storage levels below last year's levels and the 5-year average. In terms of European gas supply and demand, we note a slight contraction in total supply over the past week, while total demand remains elevated on the back of the ongoing weather conditions. Nonetheless, total demand has eased off from the levels we saw last year and the past 5-year average. On the supply side of things, we've seen a slight drop in Norwegian gas flows due to some unexpected maintenance at several gas facilities in Norway. While when we look at LNG sendouts, the slight drop also reflects the decrease in overall LNG imports into Europe, particularly as the reduction in US LNG exports remains over the last few days and expected to continue over the coming days as well. Overall, the share of LNG exports going to Europe decreased but remained above last year's levels and near the top of the range over the past 5 years. Most notably is the lower share of LNG going to Asia as we continue to see relatively muted demand for LNG from Asian importers, a sign that has been welcomed by European buyers by in turn reducing price competition versus Asia. Investment funds have reversed their positions going from net short just 2 weeks ago to now moving towards net long territory as market participants become more bullish regarding natural gas prices in Europe, very much by the lower gas storage levels, the prospect of potentially tighter LNG imports, and what the supply and demand balance will be in the remainder of the year. Coal. Moving towards coal prices, coal markets saw relatively stable prices week over week with limited movements both here in Europe and in Asia. In Asia, coal demand could see a boost, particularly from China, with some expectations of additional import demand out of the world's second largest economy. Over in Europe, while the colder weather and the increase in gas prices could lead to some additional demand from coal, particularly from the power sector, overall coal demand so far this year remains at the bottom of the range over the past 5 years, and so far has led to limited additional demand for new arrivals. EU and UK emission allowances. Regarding European carbon allowance prices, we've seen the first sharp decrease versus compared to some time ago. Overall, prices went down nearly 4% for the European market in what had been a relatively steady bullish price evolution over the preceding few months. Over in the UK, the decreases were similarly in line with those of Europe, with prices decreasing around 4% on the week. The decrease in the price level could certainly be attributed to some profit taken, given the near 3-year high price level that we were seeing in both European and UK carbon allowance prices prior to the drop. Nonetheless, prices remain quite elevated at the 92nd percentile for Europe and 95th percentile for the UK, as market participants still assess a bullish market when it comes to carbon allowances, particularly on the back of the expectations of tighter supply and demand conditions in 2026. In terms of power sector emissions, emissions have remained in line with the average over the past 5 years, only rising on the back of the colder weather and easing on the back of milder weather conditions. The improved performance of renewables over the past weeks are only adding to the slight drop in total power sector emissions over the past week. Nonetheless, investment funds continue to remain bullish when it comes to carbon allowance prices, very much due to the tighter market conditions expected in 2026 on the European side of things, and on the UK side of things, the continuing discussions and progress on linking the EU and UK carbon markets. Electricity. Moving towards electricity prices in Europe, here we've seen more stability over the past week with limited movement overall. Prices for the remainder of 2026 decreasing slightly, 1.5% for the front quarter, 1.6% for the third quarter of the year. For the frontier, we saw minimal movement over the past week, prices down just 0.6% week over week. Overall, however, prices have remained on the bullish side of things, particularly for the remainder of 2026, with prices having been steadily increasing over the last few weeks. The price evolution is quite similar across other European markets, with pricing having strengthened over the last couple of weeks in particular. In terms of total demand and residual load, we see here the impact of weather conditions, particularly on total demand, with the milder weather over the past week having brought down total demand from the highest level seen in over 5 years to closer in line with the past 5-year average. In terms of the supply mix, the French nuclear power generation is just starting to pick up again after seeing total output decrease over the beginning of 2026. Renewable output, which saw a sharp decrease, particularly due to the poor wind power generation 2 weeks ago, is starting to once again pick up as wind conditions remain more favorable. The increase in renewable power generation has then also aided in keeping fossil generation from increasing further, with total output just below the past 5-year average. In terms of renewable output, we see that the increase in total renewable output largely driven by an increase in wind power generation, although it must be noted that both hydro reservoir generation and solar generation have remained above last year's output levels. Looking at fossil fuel power generation, we note the very high demand for natural gas, particularly last week, with total output near a 5-year high. On the other hand, as we mentioned earlier, hard coal and overall coal power generation remains near the bottom of the range over the past 5 years, although once we do see those very cold temperatures, and especially when gas prices increase sharply, we do see some added demand for coal. Lastly, when we look at guarantees of origin, we note a rebound in the market, especially when we look at 2026 and beyond, with sharp increases on a percentual basis. On absolute basis, given the very low price level for guarantees of origin, we are not seeing a huge increase on absolute terms. Nonetheless, we are seeing more volatility in the market, and that could also have been driven by the volatility that we see in both gas and electricity prices as we look to those forward years. That covers this market presentation. Thank you for joining.